everyone. As you know, the visibility of the economic scenario looks compromised by the political crisis. The list of factors producing uncertainties in the political front is large. For example, the developments of the investigations of the corruption scandal, the charges against the Speaker of the House, Eduardo Cunha, the risk of resignation of Finance Minister Levy, the judiciary rulings on the investigations and on Congress, and last but not least, the articulations for an impeachment of President Rousseff. However, not only political uncertainties are weighing on the economic environment. The government made serious mistakes over the last couple of months, and that led to rating downgrade to junk by S&P, which might be followed by other rating agencies. Nobody was expecting a deep fiscal adjustment this year, given political constraints, but delivering decent primary fiscal balance this year and the next was critical for fixing the macroeconomic imbalance reflected on high inflation rates and for avoiding rating downgrades. With a cyclical fiscal adjustment, government would at least avoid extreme scenarios like the one the country faces today. That was Finance Minister Levy's plan, but not President Rousseff's desire. She weakened Levy and decided for a smoother fiscal adjustment and no further effort for sending new fiscal measures to Congress. The financial contagion from higher country risk and all the implications on the FX rate and interest rates adds to the already challenging economic environment. Corporates are struggling with asset losses, higher interest rates, higher stock of external debt, higher input prices and lower earnings. Consumers suffer from high inflation rates, especially food inflation at 10%, and unemployment rises. Default rates in the private sector are on a rise and consumers are deleveraging, while credit is tight. Whereas there was some chance for ending this year with the perception that the worst was behind us, the lack of conviction of the government on the necessity of a deep fiscal consolidation postpone this possibility. Recession will be long-lasting and a cyclical recovery of the economy will not come anytime soon because with this backdrop of unrelenting inflation, central bank will not be able to cut rates. On the other hand, further monetary tightening looks unlikely now because higher rates would mean further pressure on the debt-to-GDP dynamics. The picture today in Brazil is one of fiscal collapse and less effective monetary policy. The poor anchoring means risk of rising inflation and further FX weakening. As it was not enough, the external backdrop does not help either, whereas the contagion for Brazil looks bigger compared to peer countries. Definitely Brazil is more vulnerable and sensitive to external shocks. The scenario for the short to medium term looks worrisome. More contraction of the GDP over an already depressed base and high inflation. This is the first time since the redemocratization in 1985 that Brazil faces such a setback in the economy. Everybody wonders how the new middle class that emerged last decade will react to menaces to the status quo. In addition, what would be the implications for Rousseff mandate? Until we have more clarity on the political and social environment, caution is the watchword.
I would talk about the outlook for equities in Brazil every month and our recommended portfolio. Short comments. Today, we still have doubts regarding the Brazil political scene. The big question is, are there opportunities in equities in Brazil? Yes, there are. But with big doubts. We have no reason to buy the Bovespa index. Only a few stocks and sectors. Today, the Bovespa index trades around 11.5 times price earnings, and the historical is around 11 times in the last years, for example. The question is, the Bovespa index is cheap? No. It is expensive? Neither. But there are sectors and attractive stocks. I will mention some stocks that we think are interesting to invest. For example, bank sector, Itaúsa, is traded around 5.7 times price earnings 2016, trading below book, for example, with high ROE, return on equity, around 20% and outstanding management. Insurance sector, we think it's a good opportunity to increase exposure in the insurance sector. This sector has a natural hedge from high inflation in Brazil, for example, and high interest rates. If the central bank, Brazilian central bank, decides to raise interest rates, it's time to have exposure in this sector. We recommend exposure in SulAmérica, SULA 11, and BB Seguridade, BBSE3. In our recommended portfolios, we have 30% of exposure in this sector, our biggest exposure. And companies in this sector are trading at low multiples. SulAmérica, is traded around 9 times price earnings 2016, and BB Seguridade is trading around 12 times price earnings 2016. We prefer exposure to financial and domestic sectors in companies with outstanding management, like, for example, education sector, Croton, Cielo, a credit card sector, and CETIP. And a short exposure, for example, if you have a doubt about this specific sector, short exposure in commodities, oil and gas, mining, and steel. We think at the, for example, steel sector, Usiminas and CSN will have serious problems with lower volumes in the domestic market, and high dollar will affect that. So, short in USIM 5, USIM 5. Thanks, guys.
Investing in the stock market in 2015 has been extremely challenging, even for the most sophisticated and respected asset managers. Underperformance has been a common factor among several hedge fund gurus due to low dispersion among major stock indexes and hence the low potential to generate alpha. This has also been a year of critical changes in fundamentals due to strong trends of lower economic growth in China, Europe, and emerging markets, and at the same time, different directions in global monetary policy. This has increased uncertainty on asset prices given the difficulty to make certain valuations on these assets. Here at XP, we believe there are opportunities in equity markets, especially looking at medium-term trends. In US equity, we believe in higher return potential in some sectors than just investing in the S&P or any other major index. In September, the monthly gains of the S&P 500 were the biggest in the last 4 years, closing near the average target among US equity strategies, which is currently 2142 in the S&P cash. Though the S&P could rally further, we see limited potential at the end of this year. However, we see return potential in some sectors such as healthcare, where we like the XLV, in particular the ETF. During the earnings season, for example, of Q3 2015, we continued to see a strong revenue and earnings growth in the pharmaceuticals and healthcare services and equipment industries, both the most important industries for the sector due to aging population in developed markets, M&A activity, and further innovation of products. In fact, we believe recent comments from Republicans to try to put restrictions on prices for medicines is not an imminent threat for the industry. In US equity, we also like the consumer discretionary sector, which has shown the largest earnings growth during this earnings season. A positive outlook in the US continued to benefit the retail and media industries, especially online retailers such as Amazon, eBay, and we believe this is going to continue regardless of the high valuations on this sector, which in a zero-rate environment that we are currently facing are kind of meaningless as investment decisions. However, while the BOJ or ECB don't make these official announcements, We rather have exposure in these markets without being short in the local currency. That's why we recommend EZU for the Eurozone and EWJ for Japan as optimal exposure on ETFs.